The liquidity crisis is getting worse and worse by the day. And I'm calling this a liquidity crisis because there is not enough liquidity to go around. That is why the Fed just very recently injected $300 billion into the markets, into the banking system, because banks are failing. When banks start to fail, think about '08. Lending drastically gets reduced. That same loan that you may have qualified for and the bank may have given you before the recession, before the crisis, they're not so willing to do that now. They're buckling down the hatches. This will lead to forced loan liquidations, forced loan recalls, whatever word you want to put on it, fine with me, same concept, as well as margin calls, and then the ultimate recession. You're actually getting the biggest recession indicator that is flashing red hot ever since this banking crisis has started. So we're going to get into what this could mean for the broad markets, as well as what this could mean for AMC, because let's be honest here. What is riskier from a lender's standpoint than AMC? Than being short on the number one squeeze trade in the markets? Just let me know down below in the comment section. What's riskier at this point? It's hard to say anything is riskier than being short on AMC. So we're going to talk about the implications of all of these things and go over some key details with AMC, like the Ortex data that we have not gotten into yet here on the day. So let's get to it. Hit that like button, subscribe to the channel, source your comments, questions, or concerns if you have not already. Thank you for doing that, and let's get to it. So, Silicon Valley Bank going bust. Signature Bank going bust. First Republic looks to be shortly behind them too, is leading to a recession, and it's making the 2023 recession odds go up quite a bit. Goldman Sachs now has almost a 40% chance of a recession in 2023, which is up from 15% at the start of this year. And this article goes on to say exactly that this banking crisis is distracting the Fed from the goal of lowering inflation. And that's ultimately what helps get you into recessionary territory. But now the yield curve re-steepening is flashing its largest recession warning in 42 years in early March. Not a good situation, right? Obviously, banking crises are literally the worst thing that you can have happen to the economy. Not only do banks not want to lend out anymore, it makes other people not want to take on more risk, take on more loans. And when your economy is basically solely driven off of consumers, and that lending is very important, can lead you into a recession very, very quickly. And they see a recession in the next 12 months. Quote, I think a recession is extremely likely. I don't really see a pass through the next 12 months without getting a recession. And that is from co-founder Nicholas Colas of DataTrek. So I think it's pretty clear the recession's coming, and ultimately these banks going bust is a big step in that, right? Because when banks go bust, like I said, banks don't want to lend out capital as much, but those riskiest loans start to be recalled on. These lenders start to say, hey, if worst case scenario happened, where could we pull money from? Because banks don't keep money in the bank. Now, you could look to the treasury market, which bonds are down dramatically, so you're going to be taking losses on all of that. Or you can look to more liquid markets, such as the stock market, where you could give just a couple days notice and recall some of your biggest loans. Now, I'm not necessarily saying the $1 million loans, the couple $1 million loans are in danger here. No. I'm saying these $100 million loans or $1 billion loans. Look at the fallout of Archegos alone. Credit Suisse lost $5 billion. There's other hedge funds that these banks are lending out to, or institutions, same thing essentially, that have multi-billion-dollar loans outstanding. Now, that doesn't look good to try to raise capital or do something publicly. So it makes sense to why these banks are starting to actually buckle down the hatches. And if you talk to any lenders, if you talk to any banks, they're getting a lot more stringent on who they are lending capital out to. Well, now in the face of this upcoming FOMC meeting on Wednesday, it's going to get that much worse, because either way you put it, the Fed raises rates. That's bad for this liquidity crisis. And I'm calling it a liquidity crisis because there, simply put, is not enough money to go around. People want their money. There's losses that are piling up. We'll talk about Credit Suisse in just a second. And that's a very good example of exactly that. The losses are piling up. But after Wednesday, you're going to be in a whole new regime of the Fed. The Fed's likely to give you a 25 basis point rate hike. Likely to say, screw financial conditions. We have to fight inflation. And ultimately, that's just going to make the recession that much worse. And it's ultimately going to make banks buckle down even more. Now, get this for context. First Republic just got a $30 billion deposit. Call it from the major banks, right? That wasn't enough. First Republic was down 60% today. Jamie Dimon, the longtime CEO of JP Morgan, they said, yeah, you could just keep that $30 billion, put it in cash. We'll get it back at some point down the line. You need the money. We'll get it back down the line, as long as obviously you stay in business. Now, First Republic already told us they had $34 billion in cash. Now they're going to have roughly $60 to $65 billion in cash, and investors are still selling that stock off. Now, what is that doing to other banks? What are other banks doing right now? They're going to think about or start recalling their riskiest loans. This is always what starts a recession. This is all, well, not, I shouldn't say starts a recession. It's always one of the first steps before you go into a recession. And this next Fed meeting is going to give us a more clear glimpse on what to expect throughout the rest of 2023, because we're going to get the summary of economic projections. This is known as the dot plot, where you're going to get Fed members that plot their expectations for inflation, economic growth, right? Whether or not Fed officials are forecasting a recession now, that's going to be big. And people are going to compare this to the last summary of economic projections that we got in September. The interesting part about all of this is that the last FOMC meeting, which I believe was in February, Fed Jerome Powell said we might have to raise rates higher than what we were expecting based off of the last dot plot. That we might have to reaccelerate the pace of rate increases, and boom, a week and a half later, you get a banking crisis. I don't think it is a huge surprise. So you are going to get a lot of instability in that regard. And this Wednesday will be drastically important for the markets and the way that these banks continue to position for 2023, because ultimately there's not a whole lot of places banks can get quick liquidity if they need it besides in the stock market, because the stock market is very, very liquid, right? You buy, you sell off of a phone, off of a computer system, very liquid. Mortgages, essentially real estate, mortgages, almost the same thing. Businesses, personal lines of credit, home equity lines of credit, that's not as liquid. You can cease those credit lines, which I would not be surprised if that starts to happen, especially on the big ones. And that just leads to, again, the snowball effect leading into this recession. Now, the indicator that is really flashing red warning signs to you is the yield curve steepening. And this is what Mike Wilson from Morgan Stanley goes on to say in this article right here that we'll talk about in just a second, once this happens, usually about 3 months later, you're actually in a recession. So typically, once you actually start to steepen, you're already in a recession. Very well likely could be the case. It's not the inversion that's the scary part. It's the re-steepening that is ultimately the scary part. Now, this is what Mike Wilson had to say. This is the main headline to this article. Investors are misreading the SVB depositor rescue and shouldn't be buying stocks yet, warns Morgan Stanley's Mike Wilson. People have made fun of him because he's been a bear for a while now. I think the markets are more so disconnected from reality than Mike Wilson is wrong. I think ultimately he is going to be right. The timing has obviously not been right, and that's because the markets are very dysfunctional right now. The markets still expect earnings growth in 2023. Doesn't look like that's going to happen. Now, Wilson believes Wall Street's gains last week came from a misinterpretation of action by the U.S. officials. Quote, "We think it had to do with the view we have heard from some clients that the Fed/FDIC bailout of depositors is a form of quantitative easing and provides the catalyst for stocks to go higher," he said. Quote, "While the massive increase in Fed balance sheet reserves last week does reliquify the banking system, it does little in terms of creating new money that can flow into the economy or the markets, at least beyond a brief period of, say, a few weeks or a few days," Wilson added. After all, the Fed is lending, not buying. Quote, "If a bank borrows from the Fed, it is expanding its own balance sheet, making leverage ratios more binding. When the Fed buys the security, the seller of that security has balance sheet space made available for renewed expansion. This is not the case in this situation." And it goes on to say that the Fed's balance sheet did increase by about $308 billion, mainly lent out to depository institutions. Morgan Stanley says, quote, "Instead, we believe the overall velocity of money in the banking system is likely to fall sharply and more than offset any increase in revenues, especially given the temporary/emergency nature of these funds." The velocity of money. Ain't that a beautiful word? We used to talk about it a lot in 2021 and the beginning of 2022. It is the amount of times or the pace of which money trades hands. So, for an example, if I buy something from you, right, money changes from my hand to your hand. That's one exchange of currency, right? If you go to a store, let's call it a Dollar General, and you buy a product, your money goes from you to Dollar General. Dollar General pays some bills, they pay their employees, whatever. That dollar recirculates. The velocity of that is very important because when velocity slows down, that's where you get some very big liquidity problems and can even get worse. Now, the velocity of money has been pretty bad as of recently as a whole, but Mike Wilson says it's probably going to get worse here. And let me just reread that first sentence. "Instead, we believe the overall velocity of money in the banking system is likely to fall sharply." That means lending is going to fall sharply. That is not good for economic activity. That is not good for the liquidity crisis that you are currently seeing. So, long story short, Mike Wilson says, yeah, the markets are just a little too excited for what we're really dealing with right now, especially after all, this could be a very deep recession if this financial crisis does continue. And that's where the big problem is coming on Wednesday. Do you want a deep financial crisis, or do you want inflation to be too high for too long, in which you could get a deep recession after the Fed has to come back for round 2 and fight inflation like Volcker had to do in the early 80s? Neither one of those is really a good outcome. This will lead to banks buckling down the hatches a lot more than I think a lot of people expect. Now, when you're thinking about risk management from a bank standpoint, after all, that's what banks do, is or should do. Obviously, They all don't do it. SVB, Signature, First Republic obviously didn't have the best risk management, but they get rid or recall their riskiest loans first. That's a fact. Now, if you're looking at equity markets, we know these hedge funds and institutions that are involved with quote-unquote meme stocks have very high loan ratios out with these banks, right? They give a bank, $100 million, they borrow $1 billion, right? Look at Archegos. Give $100 million, borrow $5 billion. Just crazy leverage ratios these hedge funds have. Like, it's really bad. Now, when you start to get off sides on those positions, hedge funds meaning, it can get bad very quickly in those riskiest assets. The odds of AMC moving up 100% are a lot greater than Apple moving up 100% or Tesla moving up 100%. Banks don't want to be involved in losses that could be that big, and especially think about Archegos and all of this. That's the best example of a hedge, or Melvin Capital, right? Losing billions and billions and billions and billions of dollars. Banks don't want to be involved in that when there is a liquidity crisis, because after all, if there is any hint that you are a bank and you are having liquidity problems, think about Silicon Valley Bank trying to raise capital. Instantly was the end of Silicon Valley Bank. It created a banking run, right? Not good. So that's the last thing they want to see. So they start to recall these loans in preparation for a worse economy. And how that really affects AMC can get interesting from here, because we have court litigations coming up. Now, we have not gotten any new updates on opinions from analysts, if they think this is going to pass the banking system or if they ultimately think that this will go through. I'll tell you, in the short term, this is going to be the thing that really can influence AMC stock. And I think, just like what we seen when the litigation was first announced with AMC, AMC was up 20%. I think that's along the same lines as what we could expect this time around once we get some new announcements. But it's different because now you have a banking crisis that nobody had expected just a couple of weeks ago. That can lead to massive margin calls and forced loan recalls. And ultimately, forced loan recalls, that comes down to just banks wanting to de-risk their portfolios, because obviously it's pretty risky in the banking system right now. Now, these numbers with AMC also don't help the point here of hedge funds being short on AMC. The risk is too high. 24.24% live short interest of free float, 125.18 million shares that are currently sold short. Cost of our average 267.21%. Cost of our max 358.94%, and cost of our minimum of 0.59%. If you take a look at Interactive Brokers short availability, you have a cost of our rate of 132.18%. Earlier in the day, it was at 166.76%. It's very volatile. These readings are going up and down every 15 minutes, half an hour that we're getting them. So do keep that in mind. About 80,000 shares that are currently available to be traded. Now, if you want a long story short, all of this video, number one, recession looks a lot more likely. By Wednesday, you're going to have deeper understandings of not only if the Fed thinks a recession is going to happen, but where the Fed thinks inflation is going to go, where they think just overall economic activity is going to go, and where they think interest rates are going to go, because the markets are pricing in about 2 rate cuts by the end of 2023. So expectations are going to get reworked coming on Wednesday on all of those fronts, as well as if this banking crisis does not get better, you're going to see more and more pressure, especially on stock market investors, right? For a lack of a better word there, hedge funds, institutional investors that have these risky loans out there that might start to get recalled. Now, I think you ultimately need to see some form of catalyst to get a big reaction in stocks like AMC, and you might actually see this reflected in an overall downside move in the stock market, but a slight upside move in AMC. It doesn't all have to happen all at once, and I think that's a big takeaway of this video. From here on out, if AMC can stabilize and start to make a slight uptrend until we get good news, That's going to be very bullish in my opinion. I think ultimately the markets probably have some room to fall. AMC stock is up 2% today. That's a pretty good sign. Now, if we get news that should be bullish on AMC that turns out not to give you a bullish reaction, well, that's where I might worry a little bit more that maybe there's more room to fall. But as of right now, the risk to reward looks a lot better on AMC given this banking crisis. Ultimately, you've never been closer to margin calls over the last 2 years than where you currently are now. Not to mention if AMC does start to make big moves higher. So that is going to do it for this video. Hit that like button, subscribe to the channel, source your comments, questions, or concerns down below in the comment section. Thank you guys for watching, and I will see you in the next one.